My dear 12th class economic students, Assalamu alaikum. In our previous 2 to 3 lectures, we discussed about the different concepts of costs incurred by a firm during its process of production. Students, besides costs, a producer or a firm is also very much concerned with the revenue which he gets from selling different goods and services. So, in today's lecture, we will discuss the different concepts of revenue. Let's first discuss what the term revenue means. Students, the term revenue refers to the income obtained by a firm through the sale of goods and services at different prices. It means that revenue is the amount that a firm or producer receives from the sale of the output. For example, if a firm produces 100 units of a commodity and by selling the 100 units of a commodity, the firm gets rupees 16,000. In economics, this amount of rupees 16,000 is called revenue. Students, revenue is also called sale proceeds of a firm, as it is the amount that a firm receives in exchange for the sale proceeds. My dear students, the concept of revenue should not be confused with the concept of profit. Profit of a firm is estimated as the difference between revenue and cost related to the production of a commodity. That is, profits are equal to revenue minus costs. So, the concept of revenue is altogether different from the concept of profit. Now, the different concepts of revenue. Students, revenue has three important aspects, which are first, total revenue, second, average revenue, and third, marginal revenue. Let us discuss them one by one in detail. First, total revenue. Students, total revenue is defined as the total or aggregate of proceeds to the firm from the sale of a commodity. That is, it is the total receipts that a firm gets from the sale of its output, and it consists the total income of a firm. Total revenue depends on the price per unit of output and number of units of output sold. Thus, technically, total revenue is calculated by multiplying the price per unit of the commodity by the quantity of commodity sold. Symbolically, TR is equal to P into Q, where TR stands for total revenue, P is price per unit of output, and Q is the number of units of output sold. Let us understand the concept of total revenue with the help of an example. For instance, if a firm sells 20 units of a commodity at a price of rupees 100 per unit, then total revenue will be P multiplied by Q, that is price per unit, which is 100, multiplied by number of units sold, which is 20. Thus, total revenue is equal to 20 into 100, which is equal to rupees 2000. So, rupees 2000 is total sale receipts of the firm by selling 20 units of a commodity. Dear students, total revenue is a function of output which is mathematically expressed as TR is equal to F of Q. From this equation, it can be seen that the value of dependent variable, which is total revenue or TR, is determined by the independent variable, which is Q, or we can say output. So, total revenue is directly influenced by the output level or sales level. Thus, as output level or sales level changes, total revenue will also change. Like if sales level increases, revenue also increases. Now coming to another concept of revenue, which is average revenue. Students, average revenue is the revenue per unit of output sold. It means that average revenue refers to the revenue obtained by the seller by selling the per unit commodity. Or we can say that it is the per unit revenue received from the sale of a commodity. Average revenue is obtained by dividing the total revenue by the number of units of output sold. Thus, average revenue is calculated as AR is equal to TR divided by Q, where AR stands for average revenue, TR stands for total revenue, and Q stands for the total number of units sold. For example, if total revenue from the sale of 100 units is rupees 1000, then average revenue will be equal to AR is equal to TR divided by Q. Here TR, that is total revenue, is equal to 1000, and Q, that is the number of units sold, which is equal to 100 in case of our example. So average revenue is equal to 1000 divided by 100, which is then equal to 10. Thus, rupees 10 is revenue per unit. Students, from the definition of average revenue, we get to know that average revenue is the rate at which output is sold. Now, what is the rate? Dear students, rate refers to the price of the product. So, price and average revenue are one and the same thing. Or we can say that average revenue is the same as price of the commodity. Let us see how. Students, we know that average revenue is equal to total revenue divided by the number of units sold. That is, it is equal to TR divided by Q. We also know that total revenue is equal to price per unit multiplied by the output sold, that is TR is equal to P into Q. Now putting the value of total revenue in the equation of average revenue, we get average revenue is equal to, instead of total revenue, we will write here P into Q, as total revenue is equal to P into Q. So average revenue is equal to P into Q divided by Q. Q and Q gets cancelled here. Thus average revenue is equal to P, that is AR is equal to P. So we can say average revenue is nothing but price of the commodity. In other words, we can say that the price line which is the demand curve for a commodity, is identical to the average revenue curve. Thus, average revenue curve is the firm's demand curve for a commodity since it expresses the relationship between price and quantity sold. So, in economics, we refer average revenue curve as the demand curve of a firm. Students, an important aspect of revenue in economic analysis is the notion of marginal revenue. What is marginal revenue? Marginal revenue is the addition made to total revenue when one more unit of output is sold. That is, it is the additional revenue that the firm earns by selling one more unit of the product. We can also define it as the change in total revenue which results from the sale of one more or one less unit of output. It can be calculated as marginal revenue is equal to change in total revenue divided by change in quantity sold. That is, MR is equal to del TR divided by del Q. Del TR here stands for change in total revenue and del Q stands for change in output. We can also calculate it with the help of another formula, which is MRN is equal to TRN minus TRN minus 1, which means marginal revenue of nth unit is equal to total revenue from n units minus total revenue from n minus 1 units. It means marginal revenue is the net addition to the total revenue by selling n units of a commodity instead of n minus 1 units. Now let us understand the concept of marginal revenue with the help of an example. For example, if 10 units of a good are sold for rupees 100 and 11 units are sold for rupees 108 and we have to calculate marginal revenue, how we can do it? We will use the formula which is MRN is equal to TRN minus TRN minus 1. In case of our example, N, that is the total number of units sold, is 11 and N minus 1 is 11 minus 1, which is equal to 10 units. Thus, marginal revenue of 11th unit is equal to total revenue of 11 units minus total revenue of 10 units. Total revenue of 11 units is rupees 108 and total revenue of 10 units of output is rupees 100. So marginal revenue of 11th unit is equal to 108 minus 100, which is equal to 8. So marginal revenue in case of our example is rupees 8. One more way to calculate marginal revenue is marginal revenue is equal to del TR divided by del Q, that is change in total revenue divided by change in quantity of output sold. Here in case of our example, change in total revenue is equal to revenue obtained from the 11 units which is rupees 108 minus revenue obtained from 10 units which is 100 and change in quantity sold is 1, that is 11 minus 1. So Marginal revenue is equal to 108 minus 100 divided by 11 minus 10, which is equal to 8 divided by 1 or equal to 8. Thus here also we get marginal revenue, that is the additional revenue equal to rupees 8 from selling the 11th unit of a commodity. Dear students, in this lecture we explained the basic concepts of total revenue, average revenue and marginal revenue. However, the shape of these revenue curves, that is the shape of total revenue curve, average revenue curve and marginal revenue curve is different in different market forms. So, we will analyze the shape of total revenue, average revenue and marginal revenue curves while discussing the different forms of market in our coming lectures. Thank you.